Hey guys, Jake Breen here with Team UtahCribs in Salt Lake City, Utah. We do all things real estate, and today we're going to go over tax strategies. This is probably one of the most common questions we get, um, especially with our clients who are making a little extra money and want to invest in real estate. Sometimes they kind of want to micro invest. They wonder what the strategy is for that. Sometimes they've saved up enough capital, get their first investment property, and they're wondering if they should buy a residential rental, if they should buy a vacation rental, if they should perhaps go into a commercial deal or a business deal that has real estate tied to it. And a lot of times when we're advising on these things, it's not just the investment that we're advising on. We're also advising on tax strategy. And tax strategy is often the number one most overlooked thing in real estate. And I think what you'll find today as we go through this, it's also the thing that makes people the most money on their investment. A lot of times we focus on, will this investment cash flow? Or how much will this investment appreciate when I go to sell it? And although those things are great and we can easily put them into a spreadsheet for you, what is often overlooked is how much does this save me in taxes? And taxes are a difficult thing to insert into a projection spreadsheet or a calculator because everyone's situation is different. So I've seen many eloquent spreadsheets, especially for some of the bigger commercial deals we've purchased, that are a huge workbook with projections 10, 20 years out and what the future looks like for this investment, but nothing in the spreadsheet shows tax strategy. So we're going to go over all the ways that you're losing money if you don't invest in real estate and take advantage of these tax strategies today. Just a brief background on me. Been doing this for 23 years, spent 17 years in the full service brokerage world. I managed and operated Sotheby's when that brand came to Utah and ran the Salt Lake City office. And then I had a 9-year stint at Berkshire Hathaway managing as well as selling and building a team under their brand. I was also a national public speaker with them for 9 years. Derek is with me today. He's on Team UtahCribs and has been with us for a couple of years now and has really come out of the gates hot, has worked on a lot of transactions and has quite a few clients and investors that have asked these types of questions. So we thought we would grab a presentation we built about a year ago and teach it today and then save this. So if you're watching this, it was recorded on February 6th, 2025, and the slides I'm about to show we built in 24. So the information is still current, but you'll note some of the slides show projections of like 2022, 2024, things like that. So let's try to make it brief and we'll dive right in here. All right. So subject today is going to be minimizing taxes and minimizing your investments as a tax strategy. Let's go over tax brackets. These were 2024. These have not changed for 2025 yet, and they may change with the new administration. But if you make less than $11,600 or a married couple less than 23,200, then your tax rate is 10%. A lot of our clients that are buying houses, I'm going to say, are in these tax bracket ranges, somewhere between 22 and 24%. And a decent amount of investors we work with are in the 32, 35, or 37% tax bracket. Let me maybe say that another way. Look at the 35% tax bracket. If, as a single filer, you make 243,000 gross, up to 609, but let's just stick with that 243 number. If you make 243 or 487,000 combined gross income, we have a lot, let's say a lot of our doctor clients are in this arena, and we do sell a lot of commercial investments to doctor clients. In fact, Derek and I were meeting with a group, the Spine Institute, yesterday to look at a new building. And oftentimes these professionals are so focused on building their career, which they should be, and they're making this kind of money, and each year they're paying over a third of it in state and federal tax. And this doesn't include income tax, property tax, all the other things you're paying. So really, I would say some of our clients that aren't taking advantage of tax strategies and are making over $500,000 a year are often paying half of that money, close to half of that money in tax annually. I've seen thousands of tax returns, and it always blows my mind when I see people making that kind of money and paying half of it in tax. And even if you're in these lower tax brackets, once you add property tax, sales tax, other things you pay, you're probably paying a quarter to a third of your money in tax every year.
Hey, Jake,
Yeah,
real quick, if I'm looking at myself here, like in this tax bracket, at what point do I need to go, okay, I am losing out too much in taxes?
yeah, that's a really good question. And I had this when I was your age, and I was kind of going, all right, hold on here. I'm not making enough money that I should really pay attention to tax. Uh,
Right.
but I would tell you this. Uh, I myself have paid little to no state or federal tax in 9 years. That may sound crazy. Those watching this presentation are now going, uh-oh, what's he doing illegal? But we're going to walk you through how I've done that today. And I feel a lot of guilt that the first 12 to 15 years of my career, I didn't know how to do this, and I paid any tax at all. And so um, if you're in these arenas, I would answer your question like this. If you're in these lower tax brackets and you're saying, it's not worth it, my answer would be if you have any disposable income, savings, extra money you're making per month, if you have any disposable income you could hypothetically invest, I'm going to say um, at least 25,000 bucks. Let's make up a number. Like if it's under $5,000, it's really hard to partner with some people and buy into
Right.
real estate. But if you have even just $25,000, early in my career, I assembled 5 friends. We built a vacation rental ski cabin up by uh, Powder Mountain, and we put 20% down. The purchase price was 637,000. And so each of us only had to come up with 20 something thousand bucks as our down payment to buy that investment. And so you can assemble groups like this and then take advantage of the tax advantages of buying that real estate. So
Yeah. Okay.
good question. All right. So let's just look at different income tax rates for different states. We're here in Utah in 2024, it was 4.85%. California, it's 13.3%. So if you're making $500,000 a year W-2'd, you're paying 35% of it immediately in state and federal tax. You're paying 13.3% on everything you buy. And then you probably have property tax, and hotel and lodging tax is much more expensive than regular income tax. Right now in Utah, it's 11.7%. So again, as you add all these things up, people are paying a lot of money in taxes. All right. The question I often get when people kind of start understanding tax strategy is they go, well, what if I just put money in a 401k or a Roth or just a stock market derivative, and I let my investments grow there? How is that different than real estate? Okay. Well, let's make some projection assumptions based on investment. If you put $100,000 a year over 10 years at a 10% return, that's pretty ostentatious. The market's in our generation, our parents used to quote 10 to 12% returns. In our generation, it's been more like 8 if you average it out. But we put 10 in this calculator. So you invested $1 million over 10 years, and you did 100,000 a year in the stock market. At the 10-year mark, you'd have put in $1 million cash, and at that 10% growth, you would have 1.593 million in your investment account. That sounds pretty darn good. You've made almost 600K on your million. But what happens when you go to touch that money? We're going to go over that in a sec. Just think about it. All right, if you did that same amount for 20 years, 100K a year, you put in 2 million over 20 years and it grows at 10%, you're going to have 5.7. Okay. Isn't that crazy? Right here, you make 600K on a million, but here you make 3.7 on 2 million. Why? This is the long-term secret of the banks. If you're a conspiracy theorist, you can read about the Rothschild family and how interest was actually created. And what we're really talking about here is compounded interest. It's the time that that money sits in the market. And it really starts to take off after about 10 years. And so the only difference in these two scenarios is 10 more years of investing. All right, so if you're really killing it in your career, you put 100,000 a year in the stock market for 30 years and it grows every year at 10%, you'll have put in $3 million and you'll have 16.4. Not bad,
Yeah.
right? So if you have that kind of capital and you're certain the market's going to go up 10% a year, it wouldn't be a bad strategy to invest in the stock market. I'm a real estate expert and I do have money in the stock market. However, the big problem becomes when you go to touch this money or you go to transfer this money to your children. Here are the main 5 investment strategies to shield that investment money that you put into the stock market. And they're decent, but we're going to show you how real estate is better. So we won't spend a lot of time on these, but you should know that a 401k or a traditional IRA is money that you put in pre-tax. So you make 100 grand, and there are caps on these. I think right now the 401k per individual cap investment is about 26,000 a year. But you could do that for you. You could do it for your wife if you set up a 401k and an IRA. I've done this. I max them out each year for me and my spouse. And that money, let's say me and my spouse together put in 52,000. Then when we go to file our taxes, we show that we put 52,000 into 401k and IRA, and we don't have to pay tax on that 52. That's good. The bad news is that money grows, and if it grows over that 10, 20, 30-year period, as we saw in the 30-year projection, it could 6, 7, 8 times itself. So now it's 50K is worth 300, 350K, and we're taxed when we go touch it. We're taxed when we try to take it out. We're taxed when we try to use it or transfer it. I'd rather pay taxes on 52K than 350K, especially if taxes, as they've grown in the US, could be much greater in 30 years. Who knows? So, in my opinion, not the greatest strategy. It's a write-off. If you need it, use it, but you're going to have to pay tax on the future. 529s, the contribution, they're opposite of 401k and IRA. The money you put in initially is not deductible, but your earnings grow tax-free. And when you go to withdraw that money, it's tax-free. But it can only be used for education. So a 529 is a good strategy if you're investing younger and you want to pull money out to pay for your kids' school. Okay. And I would really advise that over a 401k or an IRA because you know, if you're putting the same amount we just discussed, 52,000, you're paying tax on that 52, and then you have to go invest the money, but you're not going to pay tax on the growth. Roth IRAs and Roth 401ks different from traditional 401s and IRAs are also that the contributions are made with after-tax dollars. So you pay tax on the money you have now, and then you invest in the Roth. And so there's no tax deduction up front, but they grow tax-free and the distributions are tax-free. So they're the same as a 529, but they don't have to be used for education.
And Jake, real quick on the Roth,
Yeah.
I've heard mixed things, but I think you can only really pull it out for 2 reasons. And one is like for a primary home purchase and for the Roth without like getting your hand slapped. And then number 2, don't you have to wait till you're like 59 and a half or 65? What is it?
Yeah, I'm glad you brought it up. I'm not sure what it is today, but
Okay.
there are rules around Roth withdrawals. And so the 529 is education only, but the Roths also come with rules. So
Mm.
it's a certain age. And here's the big cloud whenever we discuss tax strategy. We know tax strategy has always changed. We know it changes per the administration. And there's no guarantee that if you do something like this and you're banking on your retirement and being able to take advantage of these things, well, you might get stuck because the tax strategy might change.
Mm.
So another reason that we may not want to look at this, you don't get to take advantage of that tax benefit now. Last two, health savings accounts, they call them HSAs. They're a really good tax strategy. So your contribution that you put in now is deductible. Your account grows tax deferred, not tax free, and your withdrawals are tax free, but only when used for medical expenses. And same thing, there's a huge subset of rules that certain medical expenses apply, other medical expenses don't apply, and that could change. And lastly, an irrevocable trust. Um, I've heard different CPAs and CFPs suggest that you probably want to have at least a 5 million net worth to get to the point of setting up a trust. And what an irrevocable trust allows is really just safe havens you after death and allows some tax benefits to whoever is inheriting your wealth. And so removing assets, your house, your cars, your investments from your personal estate or name or entities that you own, and setting up a trust that you roll those in can shield you from the estate gift tax. And the consequences therein. Right now, the caps on those is 13.6 million for an individual or 27 million for a couple. That was in 2023. And estate taxes are up to 40%. So if you were worth $10 million in assets, you passed away, none of those assets were in an irrevocable trust, you could pretty much bank on the fact that 4 million of the 10 million that your kids inherit is going to go to taxes in one way, shape, or form when they sell the real estate or they
Dang.
touch the stock money. And that's just a flat number. Estate tax, you inherited something 40%. If you put it in a trust as a married couple and pass it on to the children, and the estate is worth under 27 million, it's not to say they would pay zero tax, but as those assets remain in the trust, they're not going to pay tax. If they extract a piece of real estate and try to touch the money, they may pay a different percentage of tax, but they won't have to pay estate tax, inheritance tax. All right, so many know Robert Kiyosaki here, famous for writing Rich Dad, Poor Dad. He's got a lot of strategies under the world of real estate investing, and he touches a lot on tax. And this is our favorite quote on tax. The people who get out of the rat race the quickest are the people who understand numbers and have creative financial minds. And derivative of that is people look at the whole encompassing investment. They don't just say, hey, I've got 250 grand. I want to buy a vacation property at the ski resort. And it'd be really cool if we could go stay there. And will it cash flow if I rent it out? And how much is it going to appreciate? Cool, I'm going to kill it. They look at tax strategy. What's the best way to set that up? What kind of entity should I put this property in? And what happens if I keep this for 80 years and pass it on to my children? They look at the entire picture, okay? So how do we get out of the rat race? Well, this is directly out of Rich Dad, Poor Dad. Um, you know, this seems pretty simple to me, but in short, if you are an employee and you have a job, you are receiving a W-2. So you make X amount of dollars, W-2, that's documented, that goes straight to the IRS. And then, yeah, individuals having W-2 income do have a few write-offs they can take advantage of, medical expense, dependents, things like that. But that's it. If you don't have any other types of income that are not W-2, whatever you make is told to the IRS, you get a W-2, you got to turn that in, and you're going to pay your fair share of tax. No ifs, ands, buts about it. If you're self-employed, you start to get some tax benefits. We in real estate are all independent contractors. Even though Derek works with me, he's not a W-2 employee of our brokerage. And so all the money he makes in a given year, I issue him a 1099. When he gets a 1099, he has many more tax advantages that he can, tax strategies he can take advantage of because of that 1099 income versus a W-2. The biggest one is just business expenses, and that's a huge gray area. But there are thousands of business expenses you can write off if you receive a 1099. You can write off mileage on your car and gas or depreciation of a vehicle, even if it's leased. You can write off all of your expenses surrounding your business. Some people take it as far as leasing an office space in their personal home to themselves because they work from home, and that's legal, and you can do that. So if you make $100 grand self-employed 1099, you can whittle down that income with those expenses and maybe only declare half of it. So already, just by being self-employed, you are far better off than W-2. In fact, I don't want to offend anyone here, but I often hear people saying, oh, so-and-so just got promoted and he's killing it. And in our market in Salt Lake City, I would say top tier W-2 earners that are managing a big business or CEO of XYZ, unless they have ownership, I would throw out a number that they're maybe making 250, 300 grand a year, and that's killing it under W-2. But then I go, well, dude, you're 35% tax bracket plus all the other tax that you might pay. So what, 40% of that 300, 120,000 goes out in tax right out the window. So you're really only making 180. And that's a true number. And people don't think about that. Whereas I know a lot of people in real estate say making the same amount of money, 300, and they're paying little to no tax once it all gets whittled down. So instead of seeking that promotion, could you go down the path of figuring out your own thing, and you could make 30, 40% less than you were being employed and still net the same amount of money in your pocket. The next step is to own the business. Now, if you have yourself 1099 and then there's other people under you, sure, we all know that, hypothetically that could make you more money, but we're talking tax strategy here. That opens up a whole nother series of write-offs. The biggest one being everyone that you employ and everyone that you W-2. And then lastly, how do you turn that cog so that you're making enough money either self-employed or as a business owner, and you invest your money, and now the money is working for you, not employees, not yourself. The money is working for you 24/7 while you sleep. Here's how we do it. So this is a real deal that we did. I own this building in St. George with my partner Josh Metal and his mother. The three of us bought this in July of 2022. We try to buy a building every year, and in the last 11 years, we've bought 9 buildings. We've had a hard time the last 2 years, 2023 and 2024, getting a building just because of where interest rates are and where the market is. We've made a lot of offers, but nothing's really stuck. And so this is our most recent purchase. This is where it gets a little complicated. So I'm not going to get way down into the weeds here. I'm just going to give you a high-level view of 2 major real estate tax strategies. They're called rapid depreciation and cost segregation. Okay. So we bought this building for $12.1 million. They were asking $12.8. We got it for $12.1. And we wanted to take advantage, all 9 of our buildings, we've taken advantage of rapid depreciation and cost segregation. Here's what a cost segregation looks like. By determining certain components of the facility, you've got to define under the tax rule of a cost segregation if items, materials in the building fall under the 1245 rule or the 1250 rule. Now, let me say one more thing before we dive into this. We don't prepare our own cost segregations. We have an accountant, a CPA, and we have a separate CPA that specializes in cost segregation studies. And when we buy a building, we hire and pay this specialist to do the cost segregation for us. So we can eke out every penny and we have an expert doing it. And these reports are pretty expensive on a building of this caliber. I think we spent about $15,000 for a cost segregation study here. However, we saved way more than $15,000, so it's well worth it. So we turn this over to our accountant. He defines throughout the building based on square footage, year built, materials in the building, all this stuff, whether things fall under the 1245 or the 1250 rule. And you have 39 years to work out how you're going to use this tax strategy, and certain materials can be fast forwarded and you can depreciate them in 5, 7, or 15-year tranches. So what you're really doing is accelerating the depreciation that you're taking on the building. So here's a high level. The building itself falls under the SL rule of cost segregation. Over 39 years, we're able to depreciate 8 million of the 12.1 million. We're able to accelerate some materials under the 150 dB rule and take advantage of them over 15 years at a value of 1.45 million. Some materials we can even accelerate faster, and over 7 years, we can deduct 416. Some materials we can do under the 5-year. We got another 1.2 million of depreciation there over a 5-year period. And then we've got the land, which we can depreciate, and the land value is just over $1 million. So we're going to depreciate the entire purchase price of 12.1. That's what you get to do in real estate. But typically, when you buy something, the old tax rule before these rules came about were that you would depreciate over like a 30 or 40-year period. So if you bought something for $10 million, you're making a $300,000 write-off of depreciation on your taxes every year for 30 years. That's good, but if you need to wipe out a large amount of 1099 income to yourself or in your business, 300 may not cut it. So under cost segregation, you can advance your depreciation and take a lot more, okay? And I'll show you what we took in year number 1 on this $12.1 million purchase. That's right here. You're probably not able to read the numbers in this recording, so I won't go through all of them. But the study that we had this CPA does breaks out all the materials and which ones we can do in the 5-year, the 7-year, the 15-year, and over 39 years, and codes them under the IRS rule and does an exact amount and a calculation, okay? So once he did that, in year number 1, we were able to depreciate $3,166,000 on a $12.1 million purchase. Let me say this another way. My partner, his mother, and myself got a $3.166 million write-off the year we bought this building, and each person got their percentage share of how much they own of the building of that write-off. And my partner Josh was the main guarantor. So I think on this building he owns 55% or something like that. And in this year, he had made, I'm just going to throw out a number here, but it was around this. In his business, he had made $4 or $5 million. So he was staring down the barrel of needing to pay somewhere between 1.5 million and $2 million of taxes at the end of 2022. Huge number, directly to the IRS, out of the business. And instead, we bought this building and he got 55% write-off of that 3.166. So he pretty much wiped out the entire amount of money he would have paid the IRS. And this is 100% legal to do. So typically he comes to me around Halloween or Thanksgiving if we haven't yet bought a building for the year, and he says, I've made X amount of dollars. I'm hypothetically going to have to pay $1.5 million to the IRS in the next 60 days, or I take that $1.5 million as a down payment and buy a building, and then I pay zero tax and I own a new investment, and it cash flows and it appreciates and all the things. In layman's terms, that's exactly what's done, and we've done that 9 of the last 11 years, which is why I've paid little to no state and federal tax. So a cost segregation, people separate them out. Depreciation, cost segregation. There are two different strategies, but a cost segregation is depreciation. It's just breaking it out in a different way under new tax code and accelerating the depreciation you can take. That makes sense, Derek?
Yeah. Hey, so I do have a question with the $12.1 million building you guys got.
Yeah.
So then after, he gets the write-off and everything that he was needing, and you don't have to go into too deep of a level here because we're not buying a new one right now, but what are those additional costs that come with, rather than paying that 1.5 million in taxes, you're taking the you're putting it into real estate. But then
Yeah.
what are the additional costs to then hold or maintain that piece?
Yeah, that's a good question. It sounds simple to make it as simple as I just made it. Hey, you're going to pay 100,000 in tax, or instead hurry and buy something and you'll pay no tax. Well, that is true, but
Mhm.
you're asking the bigger question. It's like, oh, that sounds great,
Yeah.
but what if all I have to invest is 100K and I can't just go buy a $12.1 million building? I don't qualify, on and on and on. I'll answer your question in two ways. One, cost segregation can be applied to any real estate asset investment, not a primary residence,
Okay.
anything else you buy. So you could buy a cheap little condo and still do a cost seg. I want to keep this light. There are some other rules around it. So it's possible that condo doesn't qualify. But as long as you're following the rules, you could buy something as little as a $300,000 condo. And if you have 100,000 to invest and you buy a $300,000 condo, you put 100 down, you get a loan for 200.
Mhm.
And if those are the metrics, because you put so much down, it's highly likely that whatever your mortgage is versus what you can rent it for, it's going to cash flow a little bit. So your cost is just going to be $100,000 as your down payment. And if you immediately get it rented and it's cash flowing, you're going to have no other expenses, hypothetically.
Okay.
When we do a bigger investment like this, there are some more expenses on top of that. We typically pre-fund what we call a rainy day account fund. So we try to do somewhere in the range of 5-ish% of the purchase price. So we're spending 12 something million dollars. We're probably going to want to have another 500,000 in cash on day one that we put in an account.
Mhm.
So I think on this building I own 14% or something like that, but let's just say 10% to make the math simple. If we're buying it for 12.1, on commercial loans, we typically have to put down 30%. So we had to put something like $3.6 million down. I am 10%, so I'm what would be referred to as a minority partner. So I had to come up with 10% of 3.6, $360,000 cash. plus we wanted to fund a house account of $500,000. So I needed to add another 50 to that. So I had to come up with 410,000. But 50 of it went right into an account for the building. And as long as we don't have an issue and don't spend it, that's still my money. Okay.
Right.
And then I get 10% of this $3.1 million tax benefit in year number one. So I was able to write off 300K of income. And this is a dollar for dollar savings. So if I would have owed $300,000 in state and federal tax, I wiped it out by putting it into this building.
Thank
And then let me remember on this building. This is, again, rough numbers here, guys, but I think this building is bringing in about 80,000 a month. And I think our mortgage payment on about 7 point something million lent was about $48,000. Most of our other building expenses are covered by the tenants. So I'm going to say we have another 12,000. And so after all that shakes out, the building cash flows about 20,000 a month in year number one. So as a 10% owner, I put in 360, another 50 into the house account. I'm out 410. I'm getting 10% of the 20,000 cash flow, so 2,000 a month, 24,000 a year. Now, let me pause right here. When I lay this out, right there, certain savvy investors go, Jake, you spent 410 and you only get 24,000 a year return. Well, that's only like a 5% return. I'm getting 8 or 9 or 10 in the stock market. Why would I do that? That's being very, very narrow-minded. That is only the return I'm getting on the cash flow in year number one. That's not looking at as rental rates grow, and we require most of our leases to have 3% increases every year in rent. So the next year, I'll get 3 more percent, should go right to the bottom line. After 10 years, I'm getting 30 more percent, okay, just on cash flow. Then the building's appreciating. 97 of the last 100 years, we've seen appreciation in Salt Lake County, so you can bank on that. Some years are slow, some years are close to zero, but some years are 10, 12% appreciation. So when I get to sell, that's going to be a huge return on that money invested. And then let's remember that in year one, I didn't have to wait for this for years. In year one, I saved $300,000 I otherwise would have paid in tax. So I kind of look at it as almost 100% return in year one, because I would have spent that money on tax, 300K. Instead, I put 360 in the building. So that's almost 100% return. That's almost technically doubling my money because I would have paid it tax. Does that make sense?
Yeah, I like that vision on it because, you know, rather than watching that 300,000 essentially burn because it's gone, you know, put it into something that is going to get you returns.
Yep. Now, if we haven't lost people, let's answer the elephant in the room right here. I was going to say this at the end, but I think this is a good time to say this.
Okay.
People see these numbers and see this deal we did, and they're like, rad. Hopefully I can do that at some point in my career. But we go back to the initial question you asked. Well, at what point should I start looking at this? Like, I can't put in 360,000 or whatever. Our last 2 buildings, so we've got 9 assets now throughout Utah. Our last 2, we have allowed our friends, family, and clients to micro invest with us. So I went in at 10%. But what if somebody went in at 1%? You're like, is it even worth it to own 1% of a building? Well, heck yeah. It's still the same math. On that same math, 1%, you would have needed to invest 36,000 in the down payment. You would have needed to put in what's 1% of 500, $5,000 in the house account. So you would have needed 41 grand to invest. Then you own 1% of the building. You'd still be getting about a 5% initial return on the cash flow on your 36. So that would be a couple $1,000 a year on 36 grand. And then you get to immediately write off that 36. We do pass on the cost seg to all of our investors. So whatever percent you own, you get your percentage share of that 3.16 million. So you'd have, if you made 100 grand that year and you're about to pay 35,000 in tax, you could have just invested 1% into our building, spent that money as an investment, not paid tax.
Mm.
And we will let people do that. Right now, we're not some big real estate fund. We're not federally regulated under the SEC. If you get to a certain size and caliber, you have to. We don't charge a guarantor fee or a finder's fee since Josh Metal's on the loan. And if you invested at 1%, you don't have to be on the loan. You have to be on the loan commercially if you own over 20%. So I'm not on the loan on this building, but Josh didn't charge anything for being on the loan. We didn't charge a finder's fee for investing our friends and family's money. They got to invest right alongside with us. Whatever percent you put in, that's the percent you own in the building, and that's your share of the tax advantage benefit under the cost seg and depreciation. So, yeah, you don't have to save enough money to go out and do your own. You could just invest alongside with people who are doing this and know how to take advantage of the cost strategy. Okay, so these rules were instituted under the Tax Cuts and Jobs Act. So these kind of are new rules that came about during the Great Recession. And then Trump's initial presidency, he really instilled these rules mainly because he was a real estate investor in his career and he knew how it bolsters the economy. And so he gave some awesome tax strategies for us to take advantage of. You should do them now because many of us have talked that they're going away at some point. And we were very worried a month ago, depending on who went into office, they may have gone away immediately in 2025. They're not at this moment. But the percentage benefit is deteriorating. When this rule first came out, we were coming out of the Great Recession. You could, well, the slide shows it right here. If you placed a building in service between December 31st, 2020 and January 2024, you got to take a full 80% advantage of the cost segregation study. So what you could write off was more. And 2023 to 2025, if you own the building and put it into service, that means you bought it. And let's say the building was vacant, and you had to do a remodel. Placing it in service means when you got it operable as a business and it's leased out. It doesn't have to be 100% leased out, but it's got to be operable and functioning, leased to a tenant or an owner user or whatever. If it was placed into service 23 to 25, you get 60%, 24 to 26, 40%, and 2025 to 2027, 20%. So we're trying really hard to buy another building before December or before January 1st, this coming year of 2026. So I've got 11 more months to place it in service and get 40% of the cost seg. If I do a building after that, it's going to only be 20%. Okay. So we've been making a lot of offers. All right. This is just a strategy, nothing to do with cost seg or depreciation for IRS, what's called a phase out rule, and a little special somewhere between $25,000, $100,000 write-off. I'm not going to dive too much into that just because of the time we've got. All right, here's a whole new strategy. Most people know about this one, but since we're talking all things tax and real estate, let's hit this one home. I hear so many young couples and first-time home buyers say things like, I'm not in a rush. I want to keep looking. I need to save a little more money. Oh, gee, the market's super expensive. I'll wait. My parents are letting me live rent-free in the basement. I'll wait. Oh gosh, I could go on and on. Believe me, I've heard it 1,000 times in 23 years. You are missing out big time. What savvy investors say in real estate and say to their kids is step one, just get into the game. Just get in, just get your first place as fast as possible. Why? Well, one, 97 of the last 100 years have been appreciating years. So no matter how much you save or whatever you're trying to do, real estate's getting more expensive for you as you wait. But number two, you got to get into the game so you can take advantage of the tax strategy. And there is one tax strategy for people on their primary residence, and it is this. If you buy a property, live in it and own it for 2 years, and then sell on 2 years and 1 day, your entire gain, all of your appreciation up to $250,000 is tax-free. If you're married and filing jointly, up to $500,000 is tax-free. So all you got to do is buy a place, live in it for 2 years, and you and your spouse get a tax-free appreciation gain up to $500,000. I am telling you, this is the number one tax strategy I've seen my clients, over 1,000 clients at this point in my career, take advantage of. They just don't quite realize they live in a home so long. They bought it for $350,000. We sell it 10 years later for $7,000. That's kind of a real number. Real estate has tended to double every 8 to 12 years, depending on the market, in Salt Lake County for 70 years. And they go, oh my gosh, we're so stoked. We made $350,000 on our house. But Jake, how do we write off the expenses and the improvements we put in and the commission that was paid and blah, blah. And I go, stop. You don't have to write any of it off. Your entire gain is tax-free up to $500,000. That pretty much covers everyone that lives in a place 10 years or under. And guess what? It's not a one-time thing. You can buy a place, live in it 3 years, buy a new place, same thing again. So I have a lot of younger clients that move every 2 to 3 years as they're upgrading in-house. They take all the gain tax-free. There's been discussions of that rule going away depending on the administration. So again, it's another one that really grows people's wealth when they're younger. Okay, just a few more things here. All right. To take full advantage of cost segregation that we just went through, here's the depressing part, guys. Cost segregation is difficult to do. That's why we pay $15,000 for a report. There's a lot of rules around it. The biggest rule is that the person or the spouse, the person filing taxes, has to be in one way, shape, or form a real estate professional to take advantage of the full percentages of that cost segregation. So let me put this very simply. I have 2 doctor clients who have made their spouses, who are stay-at-home mothers, go and get a real estate license so that they could take advantage of a full cost seg on their commercial investments and their dental office building that they own. If anyone's listening, they want to do that, we can help you figure that out, and we're happy to hang you or your spouse's license at our office, even if you're not really in the business, and keep it active so that you can take advantage of cost seg. It's a hoop to jump through, but it really only costs you a couple $1,000 and some schooling and passing a state exam and a federal exam, and then you're good to go. Why not do that if it could mean hundreds of thousands, if not millions, in tax savings for you, especially if you're going to invest pretty big. Under that subset of rules, they are catching on to people who just go get a license and then don't do anything, and then they take these huge write-offs. Like very wealthy people are buying $100 million buildings, and then they have some separate profession, but then they also say, oh, I have a real estate license. The IRS is catching on. So the rules basically say that more than half of your professional services have to be performed in that trade. You have to perform more than at least 750 hours of service during the tax year in real estate, in the trade business. All right, well, how are you going to audit this? How are you going to, prove this? I will just tell you, that if you want us to help you do it, we'll make sure you check those boxes. Get you or your spouse licensed, hang your license with us, invest with us, and we'll help you jump through the hoops to make sure that you're doing this. I've got some strategies that will be good tracking for you, but you don't have to go work full time as a real estate professional. Okay. One other strategy is to do short-term rentals, nightly rentals, Airbnb, VRBO. Okay. So if you don't want to go get a real estate license, but you can prove to the IRS that you are a short-term rental facilitator, not just that you bought one vacation property and you just like rent it out to friends and family or whatever, but you treat it as a business. You participate actively more than 500 hours a year in managing that short-term rental. And you can prove that your participation was substantially all the participation in the activity of the tax year. So in other words, you bought the house, you're in charge of the house, you rent it out, you talk to customers, you hire the handyman. If you can prove that you're working in the business of hotel, which is short-term rentals, and you don't have a real estate license, you can likely still take advantage of cost segregation on your short-term rental. Okay. And you can't use the house for more than 14 days of personal use per month, or it becomes a second home, and then you can't take advantage of cost segregation. That's an IRS rule. Okay. All right. The last strategy is what is called a 1031 exchange. Most people know what this is. They're like, oh, I'll do a 1031, but they don't really get the detail. So a 1031 exchange simply means you're an investor, you already own a place, you bought it for 500, it's now worth $1 million. So, and you've already taken depreciation or cost seg or all that. So you've got a bunch of write-offs, but you're about to sell this thing. And when you sell it, you show that you paid 5, you sold it for $1 million. So you're going to have a $500,000 tax gain on an investment. And you can't take the primary residence exemption because this is an investment and it's not your personal residence. In that scenario, you would highly likely want to do what's called a 1031 exchange. The unfortunate part about a 1031 exchange is you're going to have to take that 500 of gain and roll it into another piece of real estate. You have to go buy something else. You can't touch the money. You touch the money, you're going to pay tax on it. So a 1031 has been around forever. This is likely to stick around. And you cannot 1031 exchange your personal residence, but you can take that primary exemption. So let's do that on your personal residence. Any other investment, second home, vacation home, commercial property, piece of land, doesn't matter. Any real estate asset that is not your primary residence qualifies for a 1031 exchange. Okay. And so, and if you really needed a 1031 on your primary residence because your gain is going to be over 500,000 married jointly, and so you would have to pay tax on your primary, talk to us before you go to do that, because we could convert your primary residence into a rental for a certain period of time, and then it can be deemed an investment property, and we can 1031 your primary house into your new primary house so you pay no tax, as long as you do it right and jump through the hoops. So a 1031 simply says, hey, I bought a property for 500, I'm selling it for $1 million, my gain is 500. When it sells for $1 million, I will leave that $500 in escrow, either with the title company or an escrow service, and I won't touch it. And I have a certain amount of days to declare and identify a property I'm going to buy. And then I have a certain amount of days after that to close. And as long as I do all that, I don't pay any tax on that 500. Right now, the identification period from the moment you close and sell and that money goes into escrow is 45 days, and you can identify up to 3 properties. And it's a form you fill out to the IRS. You say, I sold this property, I made this much money, the money's sitting in escrow. I might buy one of these 3 properties, and then you go contract one of them, and you have up to 180 days to actually close. You follow those rules, you don't pay any tax on your gain. This is the #1 tool that savvy long-term real estate investors use, and it's the rich dad, poor dad game. You start with a condo. Your next investment is a duplex. Your next investment is a fourplex. Your next investment is an eightplex. Then you step into a commercial building, and then you upgrade commercial buildings from there. That's exactly what we've done over the last 2 decades. At one point, we had just over 100 residential units, and over a 6-year period, we exited all of those units except for 32 of them. We still have a 22-plex downtown Salt Lake by Delta Center. We have an 8-plex by OC Tanner off State Street in Westminster. We've got duplex by Liberty Park. We just kind of kept them because they were, marquee properties that were still growing. Everything else, we 1031 and bought 9 commercial buildings, paid no tax. All right. The very last thing we got to talk about is not necessarily a tax strategy, but let's go back to inheritance tax. Okay. If your parents bought a home for $100,000 and then they pass away and you inherit the home and it's worth $300,000, what has happened to tax-wise is what's called an inheritance step-up basis. So the act of inheriting it steps up the cost basis to the current market value. So, they paid 100, you got it for free, but the IRS sees that you just inherited something with a value of $300,000. So if you were to go sell that, you're going to pay full bore market tax on inheriting that asset, unless you take advantage of the strategies that we've gone through today, or your parents set up an irrevocable trust and there's ways to shield you from that estate tax of 40%. So it gets wildly expensive. This is why you hear horror stories of people thinking they spent their whole life and careers investing great and making good money, and then it all blew up upon a disaster death or even a planned death because people didn't look at tax strategy. We built this presentation in conjunction with Barbara. She's an expert. She's in a networking group that Josh Metal and I are part of the last 3 years. And so I've just put her website here. It's yourtaxcoach.com. She's got a bunch of free courses that'll dive deeper into these things. But in short, I would just tell our clients and customers that we are experts on this. We don't just regurgitate it. We've done it. We're doing it now. And the easiest thing for you would be to just either invest alongside with us or tell us what your tax situation and income situation is, and then have us help you take advantage of these strategies.
Sweet. Jake, I have one last question here.
Sure.
So I know it's been pretty epic that in the past 11 years, you've been able to go in on, 9 buildings and just have it kind of be a tax-free lifestyle, which is epic. And then in the past 2, yes, you've written up offers, but not necessarily secured a property. How are you feeling about 2025, 2026? Is it ramping back up? Are you getting back in the game? Is it a good time for other investors to jump in?
Yes. I'm very bullish on 2025. I'll give you a few reasons why. Right now, nobody else in Utah, I don't even think anyone else nationally in real estate would tell you what I'm about to tell you. If you read articles, oh, this market's soft, this asset class is soft, lowest amount of home sales in X amount of years. A lot of which is true. But in our market, the peak, I'm talking residential here, the peak pricing was May of 2022. And in a 9-month period in May of 2022, when interest rates shot up to over 7, the market shut off. And from May to February 2023, our median price went down 17%. which actually was a faster and steeper, greater decline than the Great Recession. The Great Recession was 34% decline over 4 years. Okay. And those are some of the only years in a century we've seen pricing go down. But the Great Recession, 2.5 years after that 4 year decline, when we bounced back up, it only took 2 years, less than 2.5. It was 2 years and one quarter. We erased the entire downturn. We were back to all-time highs. Then we set a new all-time high in May of 2022, went down 17% in 9 months. But then last spring, summer, we erased 8% of that 17% downturn. So median price is only sitting about 7 or 8% off of all-time peak highs. So those that are saying, I'll wait, the market's going to crash, all this stuff, well, one, it already did, and it's gained back up even with interest rates still high. And number two, yeah, you would have had to perfectly time that to get a small discount. But that's when everyone was like, I'm not going to buy, rates are too high. So I've really found people think this stuff, but they don't really do it. And you know, there's some famous old sayings in real estate: location, location, location. You can't time the market. They're wrong. I don't know why people say them. You know, I won't. I'm published in a book talking about location, location, location. So I won't go down that rabbit hole. But timing the market, you can a little bit. Here's how. As I mentioned, you won't see any of this in articles yet. But we do have a crystal ball in real estate to look a little bit into the future. And how? Why? Well, because real estate works different than anything else you buy. Why? Because every single piece is individually unique and it has an escrow period. The escrow period allows us to track one number. It allows us to track who's shopping and how much they're shopping before they close. And we do have a seasonal market in Salt Lake City. So every spring we do see the amount of homes going under contract like increase. It's usually 40 to 60% in February and March. And then that gives us an idea that we're going to sell that many more houses than we did in the prior winter. But this year, November and December were super low closing months. December, the entire county only closed 565 properties. But in January, the number of homes that went under contract was 1,115. In other words, we're up about 100% already in January with interest rates still high in the amount of people that want to buy a home than what we saw in closings in November and December. To me, that gives us that glimpse into the future. Those properties will close in February and March. Then the news articles and economists will catch up and they'll be like, oh, wait a minute, the market's booming. The last component to all of that is, what's inventory look like? Supply and demand, economics 101. We only have just over 2,000 total homes, condos and townhouses on the market in Salt Lake County. So think about it. If we have 2,000 for sale, but 1,115 went under contract in 30 days, we have less than a 2-month supply of housing. That puts things back on wildfire. So I am, unless there's a catastrophic event, I'm 100% certain that we see very strong appreciation and sales going kind of wild this spring in Salt Lake County. I was in 2 multiple offer situations the last 10 days, haven't been in a multiple offer situation in 2 years. There's another from the streets kind of data point for you. So what might that look like? What's my guess? In years like this in the past, we see 3 to 4% appreciation per month in those run-up months. So February, 3 or 4%, March, 3 or 4%, April, 3 or 4%, May, 3 or 4%, June, 3 or 4%. Well, if that happens 4 months in a row, let's put it at 3%, then a house you could buy right now or an investment you could buy right now, residential, is 12% more expensive in 120 days. Buy now at 500 or buy in May at 560. Or buy now at 500 and in May, your investment's worth 560 and you made 60 grand in 4 months. You know, people have a hard time hearing these numbers because they're like, all right, I don't touch that money. That's bull crap. These guys are salespeople. But I could back this with data and spreadsheets and history. And I'm telling you, that's what's highly likely. Then you get all the tax advantage and all those other things. Yeah, interest rates are still high. Yes, it's highly likely that investment we just walked through, if you were to do it, you get that appreciation. But where rates are at, if you're not paying cash, it is pretty likely that it won't cash flow. Or maybe it cash flows a tiny bit, or maybe you lose 100 or 200 bucks a month if it's purely just an investment property. But so what? If rates come down, which everyone's signaling they were, you refinance, it immediately cash flows. Maybe you lose or break even for a year or two, but then it's appreciated 15 or 20%. You're not touching the money yet, but you have 100 grand extra net worth because you sat on that property. Or you're just wondering about your first initial primary residence. Same thing still applies. It's still going to appreciate. Yeah, it's not an investment. You're not touching the money, but it is kind of, because you get that personal property tax exemption. So when you go to sell, somewhere between 250 or 500 if you're married is tax free. So at the root of it, I'm very bullish on 2025. I'm extremely confident we see strong appreciation and low inventory in spring. And if you're thinking commercial, I won't dive super deep here, but the commercial market is softer than the residential market. Certain asset classes are even more soft, mainly retail and Class A office. And so, yet I still think it's a good time to buy that stuff. Why? Because there's more inventory than there has been in a long time. And people who need to sell have finally gotten tired. They were cocky for a decade. Now it's been a good 2 years, 2.5 years. They haven't really been able to sell. There's not a lot of data that people are lowering price, but believe me, I'm out there making offers, and not everyone, but maybe 1 in 10 is willing to negotiate significantly. These doctors Derek and I mentioned, there was a building, the listing price was 5.3 million. It's okay, but not a great investment, maybe a break even at that number. But we were able to get it down to 4.5, 800,000 off on 5 mil. That's significant. And at that number, the investment pencils. Plus you get all the tax advantage. So I do believe now's the time. And the only reason it hasn't been the time for a while is interest rates. They're still high, but I say now's still the time, and we're probably at the tail end of them being high. And so if you negotiate a pretty good deal in today's market at today's rates, it's going to be an amazing deal when you secure it, own it, and then all you have to do 6, 12, 18 months down the road is refinance. Then as soon as you do that, you'll go significantly positive cash flow.
Well, sweet. Let's do it.
Hey guys, thanks for tuning in today. And you know our slogan here at UtahCribs, we educate you so you can make an educated decision when it comes to your real estate.